We're going to review the freeandclear.com buy versus rent comparison calculator, which is a mortgage calculator that enables you to evaluate the financial trade-offs between renting and buying a home and determine which option makes the most sense for you. Our buy versus rent calculator allows you to compare a rent payment to a mortgage payment and total monthly housing expense, and also analyze numerous scenarios including annual rent increases and changes in property value. This calculator factors in all the expenses associated with home ownership to provide an accurate comparison between buying and renting. To find the buy versus rent comparison calculator, simply click on the Mortgage Calculators tab on the top left of any page on freeandclear.com, and that will take you to a page that lists all the calculators available on Free and Clear. The buy versus rent comparison calculator is located under Home Purchase Mortgage Calculators on the left side of the page, and if you click on the triangle to the right of the calculator title, it reveals a brief description of the calculator. I'm going to click on the calculator title, which will take us to the calculator page. As you can see from the way the page is laid out, the inputs to the calculator are on the top of the page, and the outputs to the calculator are on the bottom of the page. The inputs are the information that you provide or select, and the outputs are provided by the calculator after you click the calculate button. I'm going to walk through the inputs and outputs one by one. It's important to highlight that if you ever have a question about an input, simply hover your cursor over the icon to the left of any input rectangle, and it reveals a brief description of the input and the information required. The inputs are split between two columns. The first column is the rent column, and the second column is the buy column. The first input is current rent, or the monthly rent you want to use for your comparison. I'm going to use $1,200 in this case. The next input is annual increase in rent. This allows you to compare what your rent will be in the future to your mortgage payment. In this case, I'm going to say that our rent increases by 2% every year, so I'm going to select 2 from the drop-down menu. The next inputs we have are for our buy column. First, we have the purchase price of the property. I'm going to use $300,000 in this example. Next, we have down payment. This is how much of the purchase price we are contributing as opposed to borrowing. In many cases, the buyer will make a down payment of 20%, so I'm going to use $60,000 for our down payment, which represents 20% of $300,000. It's important to note that you can certainly purchase a home with less than 20% down, so you should input the down payment amount that you are considering. The next input is interest rate. If you hover your cursor over the icon to the left of the drop-down menu, it shows the current interest rate for a 30-year fixed-rate mortgage. In this case, the current interest rate is approximately 4.250%. If you click on the drop-down menu, it reveals a wide range of options, and I'm going to select 4.250%. The next input is mortgage term, or the length of the mortgage in years. If you click on the drop-down menu, it shows a range of options from 10 years to 40 years, and I'm going to select 30 years because that is the most common mortgage term. The next input is the number of years you plan to stay in the property you are buying. This input will help us understand how your decision to buy a property looks in the future. Let's say we plan on staying in our property for 7 years. The following input is expected annual increase in property value, or how much you expect the property to appreciate when you own it. If you click on the drop-down menu, it shows a range of options from 0% if you're being conservative and you do not think the property will increase in value, all the way up to 10% if you think the property value will increase significantly. I'm going to be on the conservative side and select 2%. The next two inputs will help us determine the interest expense income tax deduction, which is one of the key benefits you realize when you own a home and pay interest on a mortgage. First, we have property tax rate. Property taxes vary by county, so check with your local authority to determine the property tax rate in your area. I'm going to select 1% in this example, which is one of the more common property tax rates. The next input is federal tax bracket. This is the highest federal tax rate you pay on your income. I'm going to use 25% in this example. Final input asks if the property requires a homeowners association fee, also known as an HOA fee. If you're buying a condominium or a property in a multi-unit development, in many cases you are required to pay a monthly fee for the maintenance and upkeep of the development. In this case, I'm going to select no. We are not required to pay a homeowners association fee. We have submitted all of our inputs, and I'm going to click on the calculate button, which will produce our outputs. There are a lot of outputs, so I'm going to address them in groups. The first 4 outputs compare your rental payment to your monthly mortgage payment over various periods of time. First, we compare your current monthly rent to your mortgage payment in the first year of the mortgage. Then, we compare the rental payment in year 7 to your mortgage payment. And as you can see, our rental payment has increased while our mortgage payment has stayed the same because we have a fixed rate mortgage. Next, we compare the average monthly rent to our mortgage payment over the first 7 years of the mortgage. And on average, our rent payment is higher. Then, we look at the total of all the rent payments we make over 7 years and compare it to the total of all the mortgage payments we make. The next outputs are used to calculate total monthly housing expense, which includes your monthly mortgage payment plus property tax, homeowners insurance expense, and homeowners association fee if applicable. So basically the all-in cost of owning the property. As you can see, when you factor in items like property tax and homeowners insurance, our total monthly housing expense is greater than our average monthly rent, and our total monthly housing expense over the first 7 years of our mortgage is greater than the total of all the rent payments that we make. The next set of outputs looks at the impact of the interest expense income tax deduction benefit, which offsets our total monthly housing expense. First, we have the average monthly tax benefit, which is how much we save a month from our tax benefit. In this case, we save approximately $260 $60 per month. Then we have the total savings from the tax deduction benefit over the first 7 years of the mortgage. Next, we compare our average monthly rental payment to our total monthly housing expense minus our average monthly tax benefit. And as you can see, when we factor in the tax deduction benefit, our total monthly housing expense is less than our rental payment, and our total monthly housing expense less our total tax deduction benefit over the first 7 years of the mortgage is less than the total of our rent payments over the first 7 years of the mortgage. The next set of outputs looks at how our property value and the value of our equity in our property has changed. First, we show the value of the property after 7 years, which is based on the annual increase in property value that we selected for our inputs. In this case, our property value has increased from $300,000 to over $344,000. Next, we show our principal mortgage balance after 7 years. So the balance on a mortgage, which was originally $240,000, is now $208,000 approximately. So we have paid down a mortgage by $32,000 over the first 7 years of our mortgage. Next, we show the value of your equity in the property after 7 years. This is calculated by subtracting your mortgage balance from the value of the property. So this is how much your ownership stake in the property is worth after 7 years. Next, we have estimated closing costs. Please note that this figure is an estimate only, as closing costs vary by service provider and mortgage type and amount. We need to take into account closing costs when considering our profit or loss from purchasing the property, which leads us to a profit or loss we realize from buying the property. In this case, because our property value has increased and our total monthly housing expense is less than our average rent, we generate a profit by buying instead of renting. At the bottom of the outputs, we have 4 bullets that summarize the comparison between renting and buying, including comparing your monthly rental payment to your monthly mortgage payment, total monthly housing expense, and total monthly housing expense less the interest expense tax deduction benefit. It's important to highlight that you can change the calculator inputs without having to refresh the page. So if I change our down payment from $60,000 to $30,000 and click the calculate button, our outputs update automatically without having to refresh the page. After you've reviewed the calculator scenarios that apply to you, you can click on the compare lenders button at the bottom of the outputs and review a table with interest rates and fees for lenders in your area. If you have any questions about the freeandclear.com buy versus rent comparison calculator or any other mortgage topic, you can always click on the Ask an Expert button at the top of any page, and it will take you to the free and clear Ask a Mortgage Expert feature where you can submit your question. The feature is free to use and we never spam. We also encourage you to review other related resources on freeandclear.com, such as our detailed discussion of the pros and cons of buying or renting a home in our home purchase mortgage guide. Thank you for reviewing the freeandclear.com buy versus rent comparison calculator.